Hey everyone, it's that time again. Check it out on your screen right now. What you see in front of you is my complete dividend stock portfolio. I own 46 dividend stocks, and I have spent my entire adult life pretty much building the dividend stock portfolio that you see in front of you right now. I own all kinds of dividend stocks, but they are really focused, I would say, on the consumer staples category, stocks like Procter & Gamble, stocks like Clorox, Coca-Cola, household brands. You'll see a lot of those in my portfolio in front of you right now. Today's video is really exciting because the last time I did one of these portfolio updates was in April of this year. Now that we're at the end of October, it's about that time. I spent a lot of time compiling some notes and some insights for the video today because when I took a look at my portfolio, there was actually some really surprising data that was coming out of the analysis. And in particular, I think we're at an inflection point right now as it pertains to value stocks, to traditional value stocks as opposed to tech stocks. I have a lot of insights to share in the video today. But before I get started, I encourage you to hit that like button and also to check out the description and the pinned comment below because you can download for free my dividend stock portfolio in Microsoft Excel format, and you can follow along at home as I go through some insights from my portfolio today. Get ready, everyone. I have a really exciting video in store for everyone today. All right, let's do this. So in preparing for the video today, I compiled some really interesting statistics from my portfolio. I'm going to go through a number of slides on the screen. So I'm going to share the first one with you right now. This is probably the most important one because it gives a summary of the financial performance of my stock portfolio since I last updated you all in April earlier this year. So one of the things to keep in mind is since April of this year, my dividend portfolio is up 7.7% in terms of the total dollar value of the portfolio. Now, one thing to keep in mind is I have been adding more money to the portfolio, so obviously that influences the performance because I'm adding net new capital all the time. And if you follow me on Twitter, I actually share all of my stock trades, or at least most of them there, for free. So make sure to check me out on Twitter as well. So what I also did on the screen right now on the second line is I have the dollar value of my portfolio without my new contributions. If I just look at what I held as of my last update and I don't count the new money deployed, how much am I up? And also I factor in the benefits of dividends over time. I'm up 4.41%. So that's a more realistic way of looking at it because it takes out the net new capital that was infused into the portfolio. Now, this performance does not factor in taxes. Now, comparably, this is probably the single biggest insight from this entire video. And before I even get into that, I'll tell you, historically, my portfolio has done very well against the S&P 500 benchmark. Now, is it really my goal to beat the benchmark or to track the benchmark? Not necessarily, because I'm investing for dividends, for cash flow. I want to pay my bills with dividends. And also, as a family man, as someone who is quite frankly at the point where I can live somewhat off of dividends, not completely, but they can fund a lot of bills for me, my risk tolerance is not what it once was. And so I really appreciate a portfolio that has less volatility, that's a little more protected on the downside in a volatile stock market. all of that being said, historically, I have tracked the S&P in recent years, and over long periods of time when I backtest my portfolio, it's done very well and it has beaten the S&P 500. I have done extensive analysis on that. I will share it in the description below. In the description, I will link to my analysis and to my video on that topic. Now, here's what's going to surprise you, and it actually surprised me quite a bit as well, and I learned a lot from this. Check it out on the screen. If you look at the third row in this table here, when I look at the S&P 500 over the comparable period, it gained 16.8%. So whereas my portfolio is up 4.41% if I do not factor in net new capital added, the S&P is up 16.8% over the same period. This is a massive divergence of my strategy versus the index. I think up front, it's very important to be clear that I am sharing my personal journey here on YouTube for fun and entertainment. I am not a guru. I am not an oracle. I don't have all the answers, but I am making the best decisions for my personal situation, which is one of living off of cash flow and not taking undue risk in the stock market. Now, worth noting, the S&P is beating my portfolio since April, but that is a very short amount of time. When you look at longer amounts of time, historically, I have tracked the index in recent years, and again, over long periods of time, I have beaten the index. Again, I will share that in the description below. But the first thing that I really want to dive into in the video today is this point, because it really tells me a few things. It tells me basically that, hey, is the dividend strategy broken here? Is a more tech-centric, growth-centric strategy the right one? Look, I will never change my strategy because I'm not looking here for total returns or capital appreciation. All of that is nice, but the reason I invest is for cash flow. That's why I do it. So that being said, for the average investor out there, for just speaking more hypothetically through the lens of just everyone out there, is this divergence indicative of more to come? Is this divergence indicative that something has changed when you compare value investing to growth investing? Put in the comments below what you think. That's one of my main takeaways from this. What is one of my other takeaways from this? It could tell me that, hey, now is a really exciting time to be a dividend investor because look, all of the growth has surged ahead, but dividend stocks, a lot of them, and I'll share some of them in the video today that have underperformed, they are on sale. There is a lot of bread and butter stocks that I own that I love that look attractively valued that are on sale. And so the other thing that this divergence tells me is, hey, is it indicative of an opportunity right now? Many of you have probably seen recently I've been making a lot of stock market purchases. I've been going more aggressively in recent weeks. One of the reasons I've done that is just as I go through my stocks, I keep seeing opportunities. And now this data kind of backs it up in a different way that, yeah, Ian, the reason you're seeing opportunities is the market has diverged. Growth stocks have taken off. And of course, the S&P 500, the top 10 stocks are largely comprised of high-tech growth stocks that have done very well, FANG stocks, if you will. And so what I'm taking out of this is that maybe, just maybe, right now is a really good time to be doubling down and investing in my value stocks and my dividend stocks because they've kind of lagged the overall market. And so that's another way I'm looking at it right now as well. Now, on the screen, check it out. What you'll also see is I just highlight my cash flow. Because I invest for cash flow, that is the number one thing I'm looking at. Stock market goes up, stock market goes down. More or less, my cash flow is predictably growing. My dividends and my cash flow since my last update in April is up 2.42%, despite being in the middle of a horrible pandemic. And so that is not bad at all. Many of my dividend stocks have raised the dividends. Some have suspended, cut the dividends, but overall, I have been very thrilled with how well the portfolio has weathered the storm from a cash flow perspective. Because again, I cannot pay my bills with capital appreciation because I don't sell. I can only pay my bills with cash flow. And so I'm excited to see that trend. And so what I'd like to do next is share another screenshot with you. I have a lot of data to go through, so check it out on the screen right now. And what I want to show you next is my portfolio yield analysis. This gives another flavor on the point I was just making. My overall portfolio right now, just on a current yield basis, not talking about yield on cost, it is yielding 3.9%. By comparison, the S&P 500 right now is yielding 1.8%. And so there's two things that come out of this. The first thing I would say that comes out of this is, look, my strategy is very different than the index. It's very different than the S&P. I'm investing for yield because I need yield because I already use yield to pay some of my bills. But what this also says, and it may just quite frankly say that it's hard to compare my strategy to S&P because they're so different just from a yield characterization. But the other way I look at this is that yield on the S&P that you see on the screen right now, 1.8%, that's a little bit lower than I would expect for the S&P. So it kind of shows, hey, is the S&P, which is largely weighted in those FANG stocks, is it a little bit overvalued right now? And the 3.9% you see on the screen right now, that is a little bit higher than my dividend portfolio has historically displayed. Historically, the yield for my dividend stock portfolio on a current basis has been more in the 3.4, 3.3% range. And so at 3.9, does that speak that, hey, the value stocks I own, the dividend stocks I own, hey, they're just a little bit undervalued right now? And so that was something interesting that I was thinking. And so again, it kind of hammers home that point that we're at a divergence right now. And either, hey, are things changing as it pertains to value stocks permanently? Is it just going to be a really different type of return on those stocks? Or is there some buying opportunity right now? And I honestly don't have all the answers, but I am very confident that there are some good buying opportunities now, at least for my personal situation. And I'm very confident in my strategy because, again, I'm not even looking for total returns. I'm looking to pay my bills. So check it out on the screen. I want to share some more fun slides, some more data from my analysis. And what do I want to do? I want to share the industry analysis. So what you see right now are some of the industries that I'm invested in. If you downloaded my dividend stock portfolio in Excel, you'll see all of the stocks. Basically, what I did is I did a pivot table on this by industry so that you can see all of the industries that I invest in. And I highlight the ones that I'm most heavily invested in yellow. And I have current allocation, target allocation. Some of those allocations have changed, the targets from last time. So you may want to take a close look at those to see how my strategy is evolving. But one of the reasons I want to show you this is basically I've been buying some energy stocks recently. And when I've been buying my energy stocks, I get a lot of comments, Ian, oh my goodness, you're crazy to be buying energy here. And I might be. I honestly might be. I'm buying oil. I love oil. Long live oil, my opinion. But what I'm trying to say is when you look at what's on the screen right now, my current allocation to oil is 2.2% of my portfolio. And so sometimes I think people see my trades on Twitter. They see what I'm doing. And I think they kind of read into it a bit too much. They're like, oh my gosh, Ian just bought 3 tranches of oil stocks. My dividend portfolio, if you will, I like to look at it at least as a monster of sorts. And so hence the thumbnail from the video today. Shout out to my friend Bernie for his creative work on this amazing thumbnail. But when I keep buying all these tranches, honestly, it's like steering the Titanic. And so it is, sometimes people think, oh my gosh, you're buying all the oil stocks. You bought Chevron, you bought Royal Dutch Shell, you bought BP. Ian, what are you doing here? You're putting too much money into it. The reason for the slide that I'm showing you right now is to give some context that, yeah, I'm out there buying oil, but at the same time, it's 2.2% of my portfolio. Even if I face a complete loss on what I'm buying, I've seen swings in my portfolio of more than 2.2% in a single day. And so even if I lost everything I put into oil, hey, it ain't going to be the end of the world. Now, people are also kind of critiquing the fact that I'm putting more money into sin stocks these days. So I want to show you on the screen what you see with the sin stocks is I have a 9.4% allocation, and it's 20% of my cash flow. That's a bit different. I've still got a big concentration there. Look, I certainly wouldn't want to see 100% loss on sin stocks. I'm taking on risk there, buying them, knowing that there's a lot of political drama around these stocks. But quite frankly, the numbers intrigue me. The margins are good. The revenues are increasing. The earnings are increasing. The dividends are increasing. So no matter how much hate people throw at these, no matter how much so many investors out there who dislike them want to say, hey, you're going out of business, sin stock. When I look at the numbers and I just look in an unbiased viewpoint, numbers are pretty darn good and they're growing. And so anyways, I feel good about it, but there certainly is a concentration of risk. But I also think, being an OG Thug Life investor, a lot of people think like, hey, my entire portfolio is sin stocks. I'm taking on all this undue risk. But no, it's less than 10%. It's 20% by cash flow, but less than 10% of my money is in sin stocks. It ain't as big probably as a lot of people are thinking when they see, Ian, you're buying all these sin stocks. So that's why I wanted to show you this slide today. Let's keep moving. Check out the next slide on the screen right now. And so what I want to show next is just a quick update on ride or die. I have done a lot of videos recently on my favorite stocks, my top 12 favorite stocks of all time. I call those my ride or die. I did another video on the next 5. I'll link to both of those in the description below. What you see on the screen right now is just where I'm at with those in terms of my current allocation versus target. In terms of current allocation, my ride or die is almost 52%. The next 5 are 11%. My goal is to take those ride or die up to 68.5%. And the next 5 up to 14. That's going to be at the expense of the ones that are at the bottom row, the no, they're not ride or die. I have to get those down from 37% down to about 17.5%. What you also see is I largely rely on the ones at the bottom for 42% of my cash flow. And so I still have a lot of cash flow concentration in stocks that are not ride or die stocks. And so the reason for this slide is really just to give an illustration to everyone of, hey, there's a lot of work I still need to do in my portfolio, and I don't sell stocks, so how am I going to do the work? I'm going to do the work by earning as much money as I can and getting it into the right stocks and reminding myself, hey, it's okay to buy oil stocks once in a while, but they're not ride or die. And so I do need to really keep focused on the big picture, if you will. Moving on, check it out on the screen right now. What I want to show you next is a quick look at just reinvesting. Right now, I'm reinvesting dividends on 65% of my portfolio, 35% I'm not reinvesting dividends. Once I change those allocations and I add more money to ride or die in the next 5, it'll skew this a bit. But right now, you just get a flavor of what I'm doing with reinvesting. And on the no bucket, the 35% of cash flow I'm not reinvesting, or actually 35% of allocation, it's actually 44% of cash flow that I'm not reinvesting right now. What am I doing? Not automatically reinvesting. What I'm doing is I'm partitioning some of it literally to pay some of my bills, and the rest of it I'm using actually to selectively reinvest into ride or die. Now, people ask me, Ian, why are you paying bills with dividends now? Why are you doing that? I'm doing it to get in the practice of spending my dividend money because I find that if I don't spend it, I'll never spend it. And so I'm trying to get in that mind frame psychologically. Hey, it's okay to spend dividend income. Moving along, check it out on the screen right now. What I want to go into next is a quick fun facts slide. And what you see is the average market cap of my holdings is 152 billion. So I'm in large cap stocks. And I also looked at all of my stocks and I partition. This is done actually based on some older data from 2019. But I partition just how much of the sales of the companies that I own come from the US, how much come internationally. 58% of revenue from all of the companies that I own come from the US, 42, and some of that includes North America too. but US as best as I could pull out, and then 42% international. And so it's nice to see that I have a global portfolio and that it's becoming even more global. I think that's very important. That's a big part of my strategy. Moving on, check it out on the screen right now. What I want to show you is some of the big takeaways that I've had from this analysis. And so again, on a total returns basis, I am losing out to the S&P over this short period of time, 4/16 through 10/30 of this year. The question is this temporary? Is this an indication that this is a great buying opportunity for value stocks? I tend to think that's part of it. Is there a paradigm shift here where tech is decoupling from traditional value and the S&P will continue to outperform my strategy? That's very possible as well. I just don't know. But we're starting to see a flavor of that at least this year. And I know I already predicted in some of my past portfolio updates that the way in which I was beating the S&P, that would probably slow down. And I thought going forward, I would probably roughly track the S&P, that it would be harder to beat it. And the reason for that is my allocation to tech is kind of low. That's something else that I probably ought to be thinking about strategically, although I do have some exposure to tech outside of my dividend stock portfolio. I have some cryptocurrency exposure, and I also have some angel investing exposure outside of my dividend stock investing. But looking just at my dividend portfolio, I don't have the biggest tech exposure. And so that's something I need to think critically about. The reason I do these videos and I put myself out there is not because I'm perfect, not because I'm a guru, but to hold myself accountable and share my story in real time with everyone out there, and to get all of us thinking, while hopefully inspiring a few of you to be your best, to set yourself up for your best possible financial future as well. But anyways, I'd be very open to comments below. I'd love to hear what all of you are thinking. So moving on, check it out on the screen. What else? I see lots on sale right now. Literally 20 out of my 46 positions are on sale. And again, this is what I'm seeing. I'm seeing something going on right now with value stocks, dividend stocks. I'm just excited because it seems to me like a good time to buy a lot of these stocks. Now, unfortunately, a lot of these aren't ride or die. They're more ancillary positions, so I have to be careful. But Kimberly-Clark is ride or die, and I think it's on sale. Campbell's Soup, not ride or die. Danone, General Mills, BP, Chevron, Royal Dutch Shell. None of those are ride or die, but they all seem to me to be on sale. Bank of Hawaii on sale. Bank of Montreal, AbbVie. J&J is on sale, and that's my number one favorite stock of all time. Can't wait to buy more. Pfizer's on sale, Altria, BTI, Philip Morris, Universal, IBM, PPL, Wells Fargo, Raytheon Technologies. 20 out of my 46 positions seem to be on sale. And out of these 20, 3 of them are ride or die, or at least on the, 4 of these. So, or on the next 5. Kimberly-Clark is ride or die. Johnson & Johnson ride or die. And then on the next 5 list, I've got Philip Morris, and I've got Raytheon Technologies. So at least 4 out of these 20, I can feel good buying, real good buying right now, because I'm getting my money into those positions that I really wanted in. So I'm really excited about that. And one thing worth mentioning is 3M. I've been buying like crazy over the last year, especially in March and April. And it seems now like it is fairly valued. And I just wanted to point that out because it's not really on sale anymore, but it was for the longest time. And there's some analyst out there saying it was going to be the next GE. I wanted to just point out, hey, analyst dude, you're wrong. I really think you're wrong. And the price so far at least has shown that. So moving on, I want to close out today with 2 charts. So check it out on the screen right now. The first chart that I want to show you is Procter & Gamble. The Procter & Gamble is the dark blue line, and the S&P 500 is the light blue line. And you can see I own a lot of stocks that are like Procter & Gamble. They basically have outperformed the S&P 500. They have done really, really well. And so it's fun to be a dividend investor because the stocks I'm buying tend not to carry a lot of risk, household goods, world-class companies like Procter & Gamble. I get a lot of cash flow, and I can beat the market, win, 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 all around. But some of my stocks, check it out on the screen right now, are more like this. They're like Altria, whereas it was keeping pace and beating the S&P for the longest time. In fact, Altria, if you go way back in time, it's the best performing stock in the US of all time, at least through the mid 2000 teens. After the last few years, probably not so much anymore. I don't know if that analysis has been updated, but they've done a lot of spin-offs like Kraft and Mondelez and Philip Morris International. This company's created a lot of value. But anyways, you can see here on the screen, dark blue line is Altria, S&P is the light blue, and they're diverging big time, way underperforming, and especially starting in kind of that 2017, mid-2017. And again, the question goes, will it recover? Or is just the strategy changing here? Is the market going to permanently value them differently? Here's a nugget of information I want to leave with you all. I want to leave this, and it's exciting because let's say the market's just starting to value these types of companies different. Maybe value companies like Altria will tend to carry lower PEs going forward. Fundamentals Altria, I think, are fine. This company's growing, revenue, earnings growing, dividends growing. Risk factors, obviously, with politics, huge risk. People hate it. But what I'm saying is having companies in the value space that underperform the benchmark, but still have underlying financials and fundamentals that are good. This actually, what I've found for myself, at least as a dividend investor, it tends to be a really good thing because it gives me as a dividend investor more time to accumulate cash flow at good levels. Because as long as Altria and other stocks, all the ones I pointed out in this video, the 20 that are on sale, as long as they stay low, when I put money in the market, I buy more cash flow because as soon as they start going up, my money gets fewer shares, and fewer shares means less cash flow. All other things equal, I'm assuming underlying financials are strong. And so anyways, I almost look at this divergence as a blessing in disguise. But hey, if the divergence lasts forever, could it be indicative of something else? I don't know, but this is an interesting time to be a dividend investor right now. I'm just enjoying having a buying opportunity here in many of my favorite stocks. So share in the comments below what you think. Please give me a big like if you enjoyed the video today. I put a lot of effort into this one and a lot of effort in creating the spreadsheet for all of you to download. Please, please support the video, subscribe, share it, follow me on social media. All of that means the world to me. If you want to get more of this, you want more of me, more motivation, more dividend stock insights, I am on Patreon as well, and I am sharing impromptu videos. This last week, I did 2 impromptu videos on Patreon. They're not as polished as the video you see here, but you get me kind of more raw and unedited, and I'm sharing insights about dividend investing there, and you can become a patron for as low as $3 a month and see all of those really cool videos. And I haven't really mentioned this before because I've always been kind of hedging my bets, but I'm at the point where I've realized I really love what I'm doing here. I'm feeling the love from the community. I'm on my path to 100,000 subscribers, hopefully soon, pretty soon here. Please subscribe if you haven't. And really, like a lot of people watching it, huge percentage watch my videos regularly, but they haven't subscribed. Please subscribe. It really helps me out, and it encourages me to produce more videos here on YouTube and on Patreon. And but what I want to put out there is I'm really trying to go big here these days, and I'm trying to make YouTube and PPC Ian a bigger portion of my life. And to do that, to make it more of that, I need to justify that. What I'm trying to say is I'm moving in the direction of becoming more of a YouTuber as a career. And as I do that, any support that I receive on Patreon, it helps me do that, helps my dreams come true, and hopefully helps me inspire even more people out there on the internet about the topic of dividend stock investing. I love you all. I am so thankful for the community here. Before I leave today, In terms of full disclosure, basically every stock I mentioned today, except Microsoft at the beginning, I own them all. So I'm not going to list all of them, but if you check the description below, I will list all of them. I own every single stock mentioned today and all the stocks in the portfolio that you all have access to. All the stocks you saw on the screen, I own all of those in my personal dividend stock portfolio. Also, before I leave today, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm literally sharing my journey here on YouTube for fun and entertainment. And investing in the market carries a ton of risk, and I don't have all the answers. I believe I have a lot of the answers for my personal situation, and I'm just sharing that journey here on YouTube. I love you all. Thank you for the support, everyone. Don't forget to hit the like button. I will see you in the next video.